Good afternoon, everyone. Welcome to our Short Verticals webcast. I'm Connie Hill. Charles Schwab, I'm happy that you would join me here today. Now, how many of you could have predicted the rip your face off rally that we had yesterday? Could you have predicted it? Did you know what was coming? Well, it happened so quickly. We're going to talk about maybe some defensive things that you could do. And just talk a little bit in detail about maybe if you're on the wrong side of a trade, what next? Okay, so keep that in mind as we get into our discussion. Now, I'm joined in the chat by Brent Moores. I'm happy Brent's here. I'll try to answer your questions, but if there's some that I can't get to, Brent will help me out there. And we want you to get your questions answered. If you're listening to this on the recording, and I know lots of you do, when you have a question, put it in the comment section of YouTube, and I'll go back and review those throughout the week so you get your questions answered as well. Now, I hope you're following us on X. I'm Connie Hill CS. Brent is Brent Moores CS, and we'll post educational content out on our X postings. Things that we notice that we think you might find interesting, we'll go ahead and post about it. Let's go through our disclosures and get down to business. Options carry a high level of risk and are not suitable for all investors. What we discuss is for information and education only. Don't consider it a recommendation. We will be using the downloaded software from on the Thinkorswim platform. It's great for education. It's great to help you learn these strategies. That paper money side can be very useful and helpful to you for those educating purposes. Investing involves risk, including the loss of principal. Past performance of any security or strategy does not guarantee future results or success. Now, as I'm looking in the chat here, I want to see if any of you predicted that this is what was going to happen yesterday. And I'm not getting a lot of takers on that, and it was kind of a big surprise. Now, for our agenda, let me tell you about upcoming workshops. This is this weekend in Detroit. It's going to kick off tomorrow. So if you've already registered for it, fantastic. Go enjoy. Denver will be coming up, and then Anaheim. And we have some scheduled later in the year as well. So find one that you can attend, all right? And you'll be happy about it. All right. In our class, typically we'll talk a little bit about short verticals. Now, this is an intermediate level class, but I want everybody to be able to keep up, even if you're newer to short verticals, okay? Hopefully you have some exposure and knowing what they are, but we'll go through some basics here. We are going to talk trade management with that idea in mind that, what if you didn't know the rally was coming, like 99.99% of people, okay? And then, of course, we're going to do a lot of examples. That's really where I want to put a lot of focus here today. Now, as far as what is a short call vertical, sometimes we give them a lot of names. We didn't make it up. Somebody else made it up, right? But we might call it a short call vertical or a bear call spread or a bearish credit spread. All of those names are just describing the same kind of trade. And I'll try to just be consistent with a short call vertical. And so what we do is we have two different legs. We have a leg that we're going to sell. It's going to be kind of our primary driver. And then we're going to buy a secondary leg that kind of acts as a hedge. And we're going to get a net credit by bringing those two together. Now, when you have sold something, you have a potential obligation. When you buy something, you have the right, but not the obligation to exercise it. And so you have both of those being represented in that spread trade. Typically, something that is bearish. All right. So what do we look to for potential candidates? Stocks that are in a bearish trend or maybe neutral to bearish. We want to focus on those stocks that have a lot of trading volume, because then we have a tendency to get number 3, which is options that have a lot of open interest, which means activity in contracts. And we have a tendency to have narrow bid-ask spreads, which is really helpful. In fact, we're going to notice kind of a problem with that here today in our market. Now, technical setups, what do we look for? Anything that you deem a bearish entry, you can do. For example, if it breaks below support or maybe bounces off a moving average, right? It ran up, rolls back over. Could be a price pattern that it breaks out of, like a bear flag. We had some bear flags last week. Or maybe you don't see any of those exactly, but maybe you see the stock run up in a downtrend, roll over, and you look for that close below the low of the high day. Okay, so all of those we're going to take as potential entry signals. Now let's hop over here to Thinkorswim. And I've got the SPX up. I mentioned to you that we have a watch list in our class that we're targeting higher volume stocks, which hopefully leads us to higher activity with options. We created a watch list here on March 20th that we're going to use for about a month, and then we're going to refresh it. Okay, so we're still using that watch list that we created. I've got a link in the a couple places you could go find that if you wanted to. There, I'll put the link in the description of our information, our write-up after our class is over. I'll put that link in there. The other way you can get it is if you are a subscriber to our YouTube channel. Makes it really easy to find our content. I'll show you what it looks like for those of you maybe that are newer, not really sure about that. Okay. And when you become a subscriber, in fact, some of you may even have a little icon there that says subscribe because you haven't, right? You can click it there. You can click in the bottom right-hand corner where it says subscribe. And then you can come in and find our playlist for our class. You can come down here. I go down about 7 rows, and then we see it right there, the short verticals. You select on that, and it'll be the one that was on March 20th. So that would be about 3 weeks ago, 2.5, 3 weeks. All right. So make it easy on yourself, become a subscriber. Now, as we hop back here to the Thinkorswim platform, let's take a look at what is going on in the markets. I know this is a little bit of a messy chart, okay? That's one thing I could get rid of, is that little thing there. This is just a 6-month view of what has been going on. I want to actually go back here a little bit further in time. We're going to come out here to a 2-year weekly chart. And on our 2-year weekly chart, we can see some longer term moving averages and some shorter term moving averages. The main thing here that I wanted to point out is this white line here had been a nice diagonal support for a long, long time for the SPX. And then it broke down. And interestingly enough, this last week, it has come down to this lower white line. Well, what does that represent? We're going to go out 5 years on the chart. Let's kind of back up here so you can see it. Oh, maybe I need to go a little longer than 5 years. Maybe I have to go 10 years here. Let's pull up 10 years. There we go. You can see it started as support clear back here on this low candle day. When was that? That was when we had COVID. We had the big sell-off on COVID. It went down. And so I connected that line here. It intersects with the low points when the market pulled back here in November. And then interestingly enough, that's exactly where it went down to this week. Looks like maybe it's bouncing from. Now, I also have on here a Fibonacci retracement. And as we look at this one, let's maybe go a couple of years so you can see this. I measured with Fibonacci's, you measure moves. So you have to have a definite peak, a definite trough, meaning you've got to have bouncing actions. We don't do it in the middle of a run. Okay, we pick the top, we pick a bottom of a move. And there's not just one move you can do it on. You can do it on several moves, but I was looking at this little bit bigger move here. And I had put in our top up here, and you can see it at 61.47. And then I took it to the low point here on that intersection. And many times these percentages that we get, these places of support and resistance, sometimes they match up with. What's interesting is it went back to this 38.2% line, which is a really common retracement area. If the SPX were to break down below that, it might stop at this 23.6, but it might retrace all the way back to this low. Okay, so if it breaks further, we could have some further down action before we see it go up. But right now, what's it doing? Well, maybe it's bouncing not only off that white line, but also today bouncing off that 38.2. Now, this is a weekly candle, okay? We talked about, this rip your face off rally we had yesterday. Sometimes that doesn't sound too pleasant, does it? Let's take a look at what we were seeing yesterday. I was on an assignment and we were looking at the charts and we just saw some explosive activity, okay? And I'm going to go back to these candles. This is a 2-day, 5-minute chart. So each of these candles represents 5 minutes in the market. When the news came out that tariffs were going to be inflicted upon China even more, but have a 90-day waiver before those tariffs started, boy, did the market rally. And if you weren't here in this 5-minute run or this 5-minute run or this 5-minute run, so 15 minutes, you might have gone out for a snack and come back and everything had changed. You were starting to see stocks just racing up the charts. I can only count a handful of times when we've seen that huge of a run in the market. So if you didn't know it was coming, I didn't either. Okay. Brent probably didn't either. But it is big enough of a move that we want to pay attention to it. Okay. Now, so far today, what happens after a big rally? Do you guys know what happens after a big rally? Yeah, we get some profit taking the next day, right? A lot of things ran up tremendously. And so first thing this morning, yeah, we saw that selling off activity. So should we be surprised that we saw that? Probably not, because we know that that's what can happen. And you can ask yourself that too. You can say, well, what do I expect next? If we had a big rally that's enormous, yeah, maybe we should think about expecting a little bit of a pullback. Now, the question is going to be, did yesterday's move change the trend? Okay, did yesterday's move change the trend? I want you to kind of ask that to yourself. If somebody want to answer in the chat, I'd be happy to kind of see what you have, what your thoughts are. But what we're seeing basically is we had still formed a lower low and we did not form a higher high. Okay, so we're still what we would call in a bearish trend. Now, what are we going to look for? We're going to look for higher peaks, higher troughs. Okay, today, actually, maybe it fits into the category of a higher low. We'll see. Okay, right? Because down here was the previous low. We had this big run up for 3 days, and then this pulling back activity here today. And this, if the stock or the market here continues to go up, that could be a higher low, the very first one. And so it could be the very beginning, but it's just too early to really tell. Okay, Isaiah says, nope, we're still under the 200-day moving average, which is my green line up here. That's our 200-day moving average. So yeah, Frankie says, no, we're still news-driven market. So no, very much a news-driven market. Now, I want to go back real quickly and show you a couple of our trades from last week. Did anybody do them in their paper account so you could follow along with me? If you did, kudos to you for following along. And if you're not, if you'll take a few minutes to put these trades in your paper money account, man, we learn so much more by watching it, having questions come up, and being able to ask your questions than we do if we're just a total spectator, right? I'm a great spectator for football games. I'm not going to go out there and play, but I'm not, not improving my skills as a football player, although I might be a little past my prime. Yeah, that very well could be the case. All right. So let's take a quick look. Last week we had 2 trades that we were able to spend some time on. We spent a lot of time on the risk profile. I hope that was helpful to those of you that were interested in that and maybe using it throughout the week. First trade we put on, or it could have been the second, was AMD, Advanced Micro Device, right? Semiconductor. And let's just kind of zoom into what we were seeing. We had seen bearish trend. We saw a bear flag. Boom, it broke out of the bear flag. We got in the trade. Okay. What happened the next day? Well, when we put in our trade, we said, get us out if we get 70% of our max gain. We're going to be happy to get a big chunk there. We're not going to look for every single penny. The next day, it gapped down, it ran down, boom, it hit our exit order the next day. I don't feel the least bit bad about trades like that. We don't usually get that big of a move, so it's not really a common thing to happen. But suppose you were just kind of being laissez-faire, not worried so much, and you just left the trade on, okay? And you're like, I'll just kind of see what happens. Maybe I can get better than 70%. Maybe I can get 95% or 90%, okay? And then you had a day like yesterday. Yesterday, this candle was so bullish. You can see it wiped out basically 4 trading days worth of activity pulling back. And by the time it closed, it was up higher than where we entered the trade. We could be in a position, had we not exited out of it, that maybe we were looking at a significant loss. Whereas a couple days before, we had a big chunk of the 70% gain on what we were expecting out of that credit. So number one, I think it's a good rule to put in an exit order that you feel comfortable with. You don't have to use 70%. You can use something else you feel comfortable with. There are some people that say, if I get 50% in one day, man, I'm taking it and I'm out of there. The second lesson I want to bring up, if that had been the case here, and had we still been in the trade on this big bullish candle day, number one, if we were in a situation where, oh man, we went from a good close to a max gain to maybe a max loss or a significant loss that you're like, oh, it's only worth peanuts now. I can buy it back for 5 cents and that's it. I shouldn't say it that way. I can buy it back, but it's really expensive and it gets me so close to my theoretical max loss. What could it get worse? If you're already at a max loss, and sometimes this kind of scenario can happen, if you're already at a max loss and you still have time, and I'm going to say you missed the boat, see what happens. See if we had a big rally here, see if you totally missed it, not a problem. You wouldn't expect, a lot of people were caught off guard, right? And just kind of see what happens the next day. See if there is a little bit of selling off activity. Because this is down what, 10 point something percent already today, even a little lower earlier. Yeah, kind of put us back in a situation of, oh, okay, it's not so bad. We were short on this trade. We did the 102, 103 call spread. So we were looking for this stock to stay below. I'm going to put my mouse in there. I didn't draw it in this time, about 102, which is where I am right now. And then 103 was the hedge leg. And man, we're back in good shape. Okay, so that's the second lesson I wanted to take away from our trade that actually went well for us, but what could we learn if we hadn't exited the trade? Okay, now as I look in the chat, I see we have a survey. And sometimes you guys that are here with us know that we'll do surveys from time to time where we're just kind of looking for your feedback. It's a simple survey, and I can be happy with simple surveys. 2 questions, just fill in the radio button, plop, plop. On a scale of 1 to 10, where are your feelings? And then there's 2 places you can answer the questionnaire if you want, or I will tell you, you can use that space to communicate something with me if you like to. Like, hey, could we cover X? I'm struggling with this concept. And you chat that in, and I like to incorporate those types of things into our content, which is last week. Those of you that were interested in seeing the risk profile, you told me about it in a survey, and that's how I knew, hey, we've got some interest in this. Okay, so if you'll click on the link right now, just let it sit in the background. Then before you leave, or our class shuts up, go ahead and then fill out the survey at that time. All right, and you'll be my favorite person forever if you do that. Actually, you're all my favorite people anyway. Okay. Any questions about what we've discussed? If so, go ahead, put those questions in. We're going to move on. Now, earlier today, I was looking at our class watch list. This watch list we designed to essentially be Something that, you know, if we saw an entry signal on it, would be interested in trading this stock. They came from the S&P 100, the NASDAQ 100, and then they also had to have, I'm trying to remember if I put a volume minimum requirement in there, it might have been 2 million. In any case, stocks coming back here that were like, oh, if I see an entry, yeah, I would feel comfortable getting into a trade on it. Okay, so I went down our watch list to find potential entries for today, and let's get into it. First one on our list that we're going to look at is Abbott Labs. Now, this might not look as good as it was looking earlier. I'm going to try it. I'm going to go down to the next one. CrowdStrike. Now, we could be having some stocks that are having a little bit of a recovery. We might end up with a candle here today that maybe looks like something close to a hammer candle. It's where you have a really long shadow and a tiny body on the candle. This is more of a cross. But if it got a little bit of a head on it here, yeah, it would look like a hammer candle. Now, what does that mean? Well, actually, I'm going to say it's not a hammer candle. This line here actually is looking like a little bit of resistance, okay? And when we see stocks up at resistance and then pulling back, because see, it's already run up here for 3 days, it would be called something else, okay? If it's at the top near resistance, we call it a hanging man, right? You've got the head and the long legs. Now, this one doesn't really have a big head yet, and we really don't want it to be that big. Think of the proportions of your regular hammer, small head, long handle. And that's ideally what we would want. Now, if it's at the bottom, we call it a hammer. If it's at the top, we call it a hanging man. Okay, you guys have all played that game before. So we could see if we're going to get that. If it were to rally a little bit, maybe run up to this resistance, but still have a real long shadow, it could end up looking like that. It's a little bit too early to tell because markets are bouncing back a little bit. But on this one, we're looking bearish, okay? The overall trend is still bearish in the market, so we're not going to fight the current. We're going to go down that way. Let's see here. Let's go over to the trade tab. And on CrowdStrike. And on CrowdStrike, there were a couple different scenarios I was looking at. First scenario was looking at the May 16 options because they're the monthly options, and there's quite a bit of liquidity in here. Okay, there's lots of open interest. Now, things have changed a little bit since when I looked at this, but what I decided, I liked the open interest here, but I liked the fact that we had some shorter increments in the weeklies. Okay, these are $10 increments. And if we come up here to the May 2s, then we're looking at smaller increments. We're looking at $5 increments. So it helps you maybe identify the strike prices you're most interested in, getting a little closer to it with a $5 wide spread instead of a $10 wide spread. Now on this, let's see if this still looks good to us here. I was looking to do the 395, 400. So here's our 395. 400 is just right next down to it. So yeah, we're looking at quite a bit of open interest for 2 or 3 contracts that we'll do in our example class account. Shouldn't be a problem. Now, something I do want to point out to you that's not ideal. But in our class, we need to take action. We need to do something. And so I'm going to point out what I don't like about it, but we're still going to do the trade. What I don't like about it is that the spreads are wider right now. Why are the spreads wider? Because we're in volatile times, right? When volatility spikes, we didn't look at the VIX, but I think you probably have seen it enough over the past few days that you know we are still in pretty high territory, okay? And so when that happens, sometimes even things that are pretty liquid, the bid-ask spread kind of moves out. And so I'm going to show you how to calculate this. Let's start here with our 395. Okay, 1380 and 1140. If we take the difference there, that's going to be what? About $2.40, right? You guys check my math, but I think that's right. So I'm going to put in 240 as the spread, and then we're going to divide it by the ask price, because really that's what the market is wanting us to pay. And that changed just a little bit, but let's go with 1130, which is where it is now. And that's going to give us a number. That number is a little bit bigger than what I typically like. This number is saying that the spread on here, and maybe it tightened up a little bit. Maybe it's not quite as bad, because there was just a $1.30 there. Let's go $1.30. We'll go on the latest number divided by 1130. And that actually got it closer to 11%, which is a little bit more reasonable. Earlier today it was in the high teens. Sometimes it would be out into the 20s. And some traders will say, I am not going to do that big of a spread. It's just too wide. And so that's why I'm pointing out that that part might not be ideal on our trades today. Okay. In real life, you might go, no, I don't want to do it when it's that wide. That represents too much volatility in a stock that actually has a lot of good trading activity. For our purposes, we're going to move ahead. So let's go to our 395, 400, and we're going to sell this vertical. So step number one, do we have a technical entry? The answer is on CrowdStrike, we do. We have a technical entry there. Next up, identifying if you've got some contracts to work with that give you enough open interest you feel comfortable. And then let's make sure we have a return here that we're comfortable with. Okay, our max theoretical gain here is $1.85, which I'm going to say that's kind of a nice premium. And what is our max theoretical loss there? It should be about 315. So let's go 185 max theoretical gain, divide that by 315 max theoretical loss. Wow, it's 58%. Now things have changed since I ran it a little bit earlier. My return wasn't that high initially. That being the case, some people might back off to do the 34 delta, but I don't like this. I would like to see more open interest here. Okay, so we're actually going to stick with this one. It still has a 67% probability of expiring out of the money, which means what? That's what we want it to do. Anything above 60, we're happy about. Now, we are looking to do here, we're going to do a couple of contracts. Now, usually in this class, we will say we're willing to risk $1,500 per trade. Sometimes you might feel like, I don't know that I want to do that much. I don't know that I want to risk that much given what's going on in our market rate. So we're going to do that in half. We're going to only risk $750. That's why we're only going to do 2 contracts here. Okay. All right. Let's set this up to have our exit order in place that we would be tickled pink with. We'll create an opposite order here. And what we used last week was 70%. You don't have to use 70%. We'll use 70% again. If we've got 70% of that spread, we've only got 30% less. So that means we're going to put in an order here to buy it back at 55 cents. All right. Again, we're not looking for every little bit out of the spread like I do my toothpaste, but we're looking for a chunk of it. All right. That's an approach some traders like to do. Okay. But we'll go ahead. We'll set this up. We're going to send it in, and we're going to put this in our bearish short verticals bucket. All right. As you have questions, feel free to chat those in. We're going to look at another example here. And one of my purposes today was actually I wanted to get a lot of trades in our example class account because I really want to work on management. Okay. Next one up, let's look at this one. I looked at Abbott, but let's look at MDT. Okay. Now let me maybe back out a little bit. Let you see maybe about a 6-month chart on this. Can see it had been rallying up, but boom, went below the 200-day moving average. This 85 was acting as support here. We got a nice bounce, but it's been acting as resistance here. So we've got a stock that looks like it's hanging up here at resistance and having a hard time getting above it. Might be bouncing down, right? Green candle, then red candle bouncing down. It's not a close below the low of the high day, but it's a significant bounce off the resistance area. So some traders might like that technical entry point. All right, let's go check out Medtronic here. Now on this one, You know, if we were looking at that same time series, the 2nd of May, it's not too bad, but we are going to just come out here to the monthlies because there is just lots. There's thousands of contracts out here. And that's kind of what we're ideally wanting to look for. Typically looking to sell a 30-something delta or maybe a high 20-something delta, and some people might look for a low 40-something delta. We actually have each of those sitting here. We'll pick the middle one. We'll pick our 32 delta. It's a 87.60 or 87.50 strike price. We are going to sell that vertical. All right, so technical entry, lots of open interest. Let's see if what we've selected here gives us a good enough return that you feel comfortable with it. And different people might have different thresholds of what they're happy with. Okay, so now this one's a $2.50 wide spread. So we're going to take 2.5 minus our max theoretical gain of 73 cents. That gives us a max potential loss of 177. Okay, and we're going to put 0.73 equals our max theoretical gain. To get the return on that, we just divide the max gain by the max loss. And we see where that lies. We'll look at it here. So 73 divided by $1.77 gives us 41% return. Okay. If somebody wanted a better return than that at a lower probability, then they might sell the 44. If somebody wanted to raise their probability of it expiring out of the money, you could go further out, but there's always that teeter-totter. You'll bring in a lower credit, and what you sacrifice is, or you sacrifice the lower credit to have a higher probability. Now, this one kind of hits a sweet spot for most people. It's above 60. It's up there about 71. Okay, we're going to go ahead and do that. Now, on this one, because the max theoretical loss, let's divide. Let's see if we can still do the same number of contracts I wanted to. So we're going to say 750 is our max theoretical loss because we're taking into account the bearishness in the market, okay, and the volatility and maybe not wanting to put a full position out there. And we're going to divide that by 177, the max theoretical loss. We can do 4 contracts. Okay, so we're going to do it. Let's change our quantity there. Okay, what's the next step? I want you to maybe tell the dog, tell your computer in your mind, what's the next step? Okay, next step is, let's see when we might want to get out. We're going to do a first trigger sequential. We'll create an opposite order here. When we get a chunk of this, okay, this time, you know, it's a kind of a nice return there, 40+%. Maybe we don't have to maybe get as much out of it. What if we do say, well, let's stick with our 70%. I won't go more greedy. I was thinking maybe 75%, but we'll go 70% here. So we'll take our 0.3 times 0.73. And so when we've got 70%, only 30 is left. We're going to say, fine, go buy this back, 21, 22 cents, however you want around that. We'll just go with 21. All right, we're going to make this good till canceled. We're going to kind of size it up, make sure we're not exceeding our risk, which we're not over 750. And we're going to put this in our bear short vertical bucket and send it on in. Yeah, so that's going to be one predetermined exit, as if we get that gain. Now, I'm going to kind of check here on, we did get filled on CrowdStrike. We'll see if this fills for us. It might fill for us. If I have to go back and change it, I will. All right. Next up, I'm going to get a bunch of these done. This is awesome. Cisco Technology. It's kind of a similar setup to what we were seeing there on Medtronic, in the sense of been upward trending like so many things in the market were, and then just got hammer smashed, right? Went below the 200-day moving average, which sometimes we'll see stocks bounce at a 200-day moving average. And it looks like, what did it do yesterday? Ran right up to this line I'd already drawn from back here that was support. Old support many times becomes new resistance. Looks like that's where the market ran to yesterday, and then today possibly bouncing down off of there. Now, this is looking closer to what I was describing as a hanging man. And if it continues to rally up a little bit, the head here will be a little bit smaller and it'll look more like a traditional hanging man should. And so I'm going to say it's kind of ish looking, hanging man-ish. Okay, because you can imagine this guy's still got too big of a head at the moment, but we'll see if the message isn't, similar. It's the fact that the bears pushed it down. We went way, deep into the body of this bullish candle. Bulls are pushing it back up again. So we'll see if that really acts as resistance for the stock. Cisco too, when I was looking earlier, it had a little bit wide spreads here. Let's see here on these. 365 by $4. That's less than 10%. And some traders like to draw the line at 10%. And the activity out here is really quite nice. Let's see here if we look at the May 2s. Just kind of want to see where it is because I was contemplating between the two of those. And initially I was looking at doing the 58 and the 60. Not so comfortable with the open interest here of 43 and 1. So if you don't like what you're seeing based on what you typically like to choose, okay, for example, if you typically like to choose a 30-something delta and you're just seeing 44 contracts here, just close it up, come back down to the monthlies. Okay, that's what we're going to do. We're going to go with this 60, 62.50. Going to sell that 30-something delta. Hopefully this is kind of creating a pattern for you, a pattern that you can repeat and practice yourself in your own paper money account. Okay, we found the entry. We found some open interest in terms of contracts that we could use. Let's see if it gives us a return we're happy with. All right, our max theoretical gain here is going to be 66. So I'm going to just type 66 in there as our max gain. And then let's go see what our max theoretical loss could theoretically be, right? It's going to be 250, the difference in our strikes minus the credit. That's going to give us $1.84. So it's actually going to be somewhat similar to our previous trade there. So let's take our 66 cents divided by 184. That's going to give us our theoretical rate of return, 35%. If that fits your wheelhouse, great, right? Some people might want it a little higher for a lower probability trade. Some people might want a bigger return, but then they'll sacrifice the probability of success. 70% is just kind of in that sweet spot that we like to target. Now, if we are going to risk 184 here, I think we're only going to be able to do barely 4 contracts. Okay, so let's go ahead. Let's do our 4 contracts. We're going to create an opposite order. Oops, Connie goofed. Create an opposite order here. First trigger sequential. Now we'll do our opposite order. And we've got our 4 contracts there. Now, if we get a big chunk of our 66 cents, what are we going to do? Are we going to look at it and let it go by? No, we're going to have our exit already sitting there for it. Okay, so 66 cents if we get, let's go 80% here, okay? If we get 80% of it, then only 20% is left, so we'll multiply that by 0.2, and we'll say, okay, we'll go buy it back at 13 cents. Now, if we get a big chunk of this early on, like in the next 2 days, let's get down the right value, then we might choose to get out of it early and say, we're satisfied with 50% or 60%, right? There's nothing that says you have to keep it as it is. You certainly are free to go change it depending on what you see in the markets. Let's hit confirm and send this little guy on its way. Now, do you suppose there could be other potential entries on this list? I think there very well could be. Most stocks are looking really similar to each other. They're looking similar to what we're seeing on indexes, which we didn't really look at NDX, but it's going to look similar to what we were seeing on the SPX, where down below the 200-day moving average looked like it had been in a flag pattern. Boom, yesterday got out of the flag pattern. NASDAQ really recovered really nicely yesterday. But interesting, this line that I've had here for a while, at about 1875. It looks like it's a resistance area. Looks like it kind of penetrated it yesterday, but then today it can't get past this horizontal area. Now this is looking like a better hanging man. If we're looking for a hanging man candle, we'd say this is a hanging man at resistance. These reversal candles typically are more useful, more reliable when they're at areas of resistance or areas of support, depending on if it's giving you kind of a bullish signal, bouncing off support with maybe a hammer candle, or here bouncing off resistance with a bearish candle. All right, hanging man candle. Very good. Let's see here. Melissa says, because verticals default to the mid price on Thinkorswim platform, if the bid and the ask are spread wide, it can show. Yeah. Some of these were a little bit, let's go back to Cisco here. Some of these were a little bit wider than we want, and that's kind of why I pointed that out on our first trade. Some traders might decide to skip back to, might decide to pass if it's too wide. This seems to be settling down into a little bit more of I'm going to say a normal range for what this stock typically does, because it has lots of trading activity on it. Let's see here. All right. Yeah, Melissa says, yeah. Kevin says to Melissa, yeah, sometimes these spreads are crazy. And that goes back to maybe an earlier point of a trade that we hit our exit last week, day after we got in, right? Hit our exit, we got out, we were happy. But if we were still in yesterday, even with that rally, did you guys notice the spreads? They got really wide on things. Yeah. So it can happen in a bearish market as well as a bullish market. All right. Now, I hope that you're doing your own practice short vertical trades. It's the best way to learn is to just go in your paper money, put something together. You can use our class trades as examples. And that can give you some good ideas, especially if you're not feeling comfortable putting the whole trade together. It's like, okay, let's just do the same practice trade that we're doing as a practice trade in our class. And then you can follow it along, and then we'll come back and talk about it the next week and hopefully maybe answer some questions you had, and you can go ahead and ask questions knowing that that is the case. All right, a couple of asks I have for you. Number one, that survey. It looks like we got Brent to post that survey link in there again, so it's right fresh at the very bottom. If you'll fill that out for us today, we always appreciate the time that you do take to do that. We value your feedback and would love to hear your comments. Okay, so tell us as much as you want. If you're not a subscriber yet, make it easy on yourself, go subscribe. And then Brent would love to have you follow us in X. Brent is Brent Moore CS, I'm Connie Hill CS, and just get in on that content, those little nuggets throughout the day. You've been great. Next week, we've got some trades to follow up on. We'll see how they do. Good luck as you practice trading this week. See if you can get in 3 practice short verticals. Okay, 3 of them before we meet again. All right, you guys have a great afternoon. Coming up next is Getting Started with Stock Investing. And it'll start right here, right at the top of the hour. So go get a little snack and come on back. If this was a little bit much for you, then Getting Started with Stock Investing should be much easier and actually quite an interesting topic for where we're at right now. I will post in here just one more time our playlist for the short call verticals. All right, guys, we'll see you next week. Bye-bye.